Good afternoon. Today we're going to cover Chapter 11 and 12, only part of it, the internal control and the COSO framework from Chapter 11, pages 356 to 364. I suggest you read. I'm not going to test over them, but you should read them. There's some value in familiarity. Chapter 12, Assessing Control Risk and Reporting on Internal Controls. The last 3 pages, 395, 398, again, I would just read only. Be careful as you go through, because in this section, we're going to move between private companies and public companies, So make sure you understand where we're at each point of the lecture. I'm a believer that internal controls are absolutely necessary and they don't work. And that sounds inconsistent, but I believe it. So internal controls prevent people are more reluctant to steal, cheat if they know their controls, then they might get caught. If they know they're going to get audited, but they can always be circumvented. So I think they're essential to have, but they need to be they can't always be circumvented. So this is Bering Bank, a little box on 353, and a junior trader gambled more than the entire net worth of the bank and lost that gamble. So JP Morgan in 2008, during the financial crisis, Jamie Dimon was considered and still is considered, one of the best bankers in the world. JP Morgan Chase is great. But a couple years after the 2008 financial crisis, a trader in London lost $6.2 billion for JP Morgan. And first of all, JP Morgan wasn't even aware of the loss, and then they weren't aware of how large it was. So even the best run bank in the world, arguably, somebody could circumvent the controls and lost over $6 billion. Now, what is important is you hire the right people. If you hire people whose goals and values are congruent with the goals and values of the organization, those people will tend to do the right things. They'll tend to do the things the organization supports and values. This is just background. So in 1987, there was a National Commission on Fraudulent Financial Reporting. It was nicknamed the Treadway Commission. And the organizations that sponsored that commission were the AICPA, the American Accounting Association, the Internal Auditors, Institute of Management Accountants, and Financial Executive Institute. So these are referred to as the Committee of Sponsoring Organizations. So these are the 5 organizations that sponsored the National Commission on Fraudulent Financial Reporting, and so people refer to it as COSO. You don't need to memorize that. You don't need to, but you're going to hear the word COSO a lot, and that's what it refers to. Now, on the day 1 handout, there's a definition of internal controls. It's huge. It's from COSO, and you'll have to learn it virtually word for word. Internal controls, a process affected by those charged with governance, management, and other personnel, designed to provide reasonable assurance about the achievement of the entity's objectives with regard to 1, reliability of financial reporting, 2, effectiveness and efficiency of operations, 3, compliance with applicable laws and regulations. So internal control is a process affected by people to provide reasonable assurance the organization will achieve its objectives. This played a big role for me because it was the first time I ever thought about risk in terms of not achieving your objectives. Anything that may prevent you from achieving your objective is a risk. Notice the bottom three, reliability of financial reporting. That's the one we focus on. If I own the company, that's probably third most important. Effectiveness and efficiency of operations. I want my company to be effective and efficient and profitable. Now, compliance with applicable laws and regulations is very important, because if I don't comply with the laws, they can put me in jail or shut me down. Reliability of financial reporting, it's kind of important because I need it to get a bank loan. But make sure you realize that auditing and financial reporting may not be as important to the owner of a company as it is to you. So it's necessary, but always remember their priorities. Foreign Corrupt Practices Act. You don't need to know this. 1977. The reason I point this out is companies have been required to maintain effective internal controls for a long, long time. So any company, it's called Foreign Corrupt Practices Act, and that has to do with why the enact was originally initiated, but it really has nothing to do with foreign operations. Any corporation that has registered with the SEC is subject to the Foreign Corrupt Practices Act, even if they have no foreign operations or no foreign business. That was just the title. So it applies to all companies who are required to file reports with the SEC. Now, you sure don't need to know this, but I want you to think about it. So in 1977, companies were required, public companies, to devise and maintain a system of accounting controls sufficient to provide reasonable assurance that transactions are executed in accordance with management's general or specific authorization. Management's general or specific authorization. So anything that goes on in the company should be authorized either generally or specifically by management, and they need controls to make that happen. Now, general authorization, specific. Specifically, if the boss tells you to do something, he's given you specific authorization. General authorization, maybe some Miller Motor Company. I may tell all my salesmen that they're authorized to sell a car for the sticker price. Now, if the customer wants a discount, then they have to go to the manager to get specific authorization. I may give managers authorization to spend up to $5,000 or $10,000 at their discretion, for the business at their discretion. Anything beyond that may require specific authorization. Many general authorizations are embedded in the computer. So what are the credit limits for various customers? They're probably embedded in the computer. To prepare financial statements that conform to GAAP, to maintain accountability for assets. The access to assets is permitted only with the general or specific authorization of management. The recorded accountability of assets is reconciled with the physical assets at reasonable times. So in 1977, companies were required by the law, at least public companies were required by the law, to maintain effective internal controls. Now here's the PCAOB report. We're not learning this. This is the report for a public company, and just by comparison, note what it says. They've got a section in there about the internal controls as a process a process designed to provide reasonable assurance regarding the reliability of financial reporting and the preparation of financial statements, maintenance of records that in reasonable detail accurately and fairly reflect the transactions and dispositions of assets of the company. Reasonable assurance that transactions are recorded as necessary to permit preparation of GAAP financial statements. Receipts and expenditures of the company are made in accordance with management authorizations. There's reasonable assurance regarding the prevention or detection of unauthorized use, acquisition, or disposition of the company's assets. So I don't think it's terribly different from what we saw in 1977 under the Foreign Corrupt Practices Act. So this paragraph's included in the audit report for public companies. Sarbanes-Oxley says that management must issue a report, and in that report, with their annual report, that state that management's responsible for establishing and maintaining adequate internal controls. Management must provide an assessment as of the end of the most recent fiscal year of the effectiveness of the internal controls. So management must state that they're responsible for establishing and maintaining adequate internal controls, and management must also assess the effectiveness of those internal controls. Then Part B says the auditing firm, each public accounting firm that audits registered companies, must issue an audit report for the registrant and attest to their report on the effectiveness of internal controls. .315, I hope you know it by now. Identify and assess the risk of material misstatement to provide a basis for designing and implementing our audit responses to the risk of material misstatement. Control risk. The risk that a material misstatement could occur in an assertion. When I see the word assertion, I think transaction balances and disclosures, and will not be prevented or detected and corrected by the internal control. Reasonable assurance is a high but not absolute level of assurance. Sarbanes-Oxley, this is on page 344. We already talked about it. Management must make the following statements. Management must state that they're responsible for effective internal controls over financial reporting, and management must assess the effectiveness of the internal controls. Third thing, management must state the framework they use to evaluate the effectiveness of internal controls. So management has to issue a report regarding their internal controls every year, and it must contain these three statements. Most companies in the U.S. are going to use the COSO framework to evaluate the effectiveness of their internal controls, Committee of Sponsoring Organizations. Okay, management's responsibility. Management's responsibility for the preparation and fair presentation of GAAP financial statements. Management's also responsible for the design, implementation, and maintenance of internal control relevant to the preparation and fair presentation of GAAP statements that are free of material misstatement. Okay, so do you need to know that word for word? No, this is in our private company audit report, and we reinforce in there what management's responsibilities are. Management's responsible for the financial statements. Management's responsible for effective internal controls relevant to those financial statements. Okay. Significant classes of transactions. By now we're starting to understand we don't audit everything on the financial statements. We audit significant classes of transactions and significant account balances. This is out of AU 315. We just learned the objective for 315, but there's a lot more to it than just that one paragraph. Page 345 talks about the design of internal control. It says we need to identify the points in transactions where material misstatements could occur. Whoa, that's a tough one, isn't it? I mean, anything that could go wrong can go wrong, right? So, but we need to understand the internal control well enough that we can determine what the points are in the transaction where a material misstatement could occur. Okay, so we're going to evaluate each and every significant class of transactions and identify how each class of transactions is initiated, authorized, recorded, processed through the accounting system, and reported in the financial statements and disclosures. Doesn't that describe an accounting system? How are transactions initiated? How are they authorized? How are they recorded in the accounting records? How do they get processed from the journal or wherever they're recorded through the accounting system into the general ledger, and then from the general ledger, how are they reported in the financial statements? And oh, by the way, how do they capture the information necessary for disclosures? So to me, this is saying this is an accounting system, and we can't say we understand a company's internal controls unless we can document this about each significant class of transactions. If we can't document how each transaction is initiated, authorized, recorded, processed, and reported, how can we convince anybody we actually understood the internal controls? Now, this is right out of 315. Like I said, we learned one paragraph, but this is a whole, probably 100 paragraphs to it. Procedures by which transactions are initiated, authorized, recorded, processed, corrected as necessary, transferred to the general ledger, and reported in the financial statements. Isn't that very similar to what we just read? So I really want you to know this paragraph. Now, they also add how the system captures events and conditions other than transactions that are significant to the financial statements. And finally, process used to prepare the entity's financial statements, including estimates and disclosures. So this first part, when I say I want you to know it, think about it. Shouldn't you know how transactions are initiated, authorized, how they get recorded in the accounting system, how they get processed from the journal into the general ledger, and then transferred to the financial statements? That's what it's saying. So those are transactions. How does the system capture events and conditions other than transactions? Those might be our adjusting journal entries. And then we've got our disclosures. So I'm really worried mostly about that first paragraph, but I also want you to reflect on what 319, this is not in the book, but reflect on what 315 says, because it also talks about, wow, this accounting system, this control structure also has to capture the needed information for adjusting entries and disclosures. Auditors must document their understanding. Okay, so think back to the chapter on legal liability. Odds are very good when the company gets sued that you will have already left for another job. So everything has to be clearly documented and well documented. We're going into the courtroom. I believe the jury's already biased. They think you're guilty. And so you have to have excellent documentation to show that, gosh, I had a good understanding of the accounting system. Okay, again, this is our private company audit report, and here's our little boilerplate. Obtain and understand the internal control relevant to the audit in order to design audit procedures that are appropriate in the circumstances. So we need and understand the internal control before we can design the appropriate audit procedures. That makes sense. but for private companies. But for private companies, not for the purpose of expressing an opinion on the effectiveness of the internal control. Accordingly, no such opinion is expressed. This is boilerplate. Now, you've had more accounting than 99% of the people in the world. My guess is if somebody would have asked you, many of you would have said companies are required to express a report on their internal controls, and auditors are required to attest to it. No, that's public companies. And when Sarbanes-Oxley hit, there was a lot of talk about Section 404. People assumed that it applied to all companies. No, it just applies to public companies. So this is a little boilerplate. Hey, Mr. Investor, or hey, Mr. Banker, this is a private company. And although we obtain and understand the internal control, it's not for the purpose of expressing an opinion on the effectiveness of their internal control, nor do we express an opinion on their internal control. Tomorrow we're going to discuss the components of internal control.